Hello, and welcome to Your May Forethought. I'm Nathan.
I'm Lauren.
I'll get right into it. This is our Forethought newsletter. Thanks for joining us. We have 4 ideas we're going to cover: market thought, risk thought, planning thought, and then we'll end with a forward thought. There's a lot to talk about, and we're trying to, as Lauren would say, trying to keep these concise and just deliver what we think is important information.
It's always tough because a whole month goes by and so much has changed. We want to give you all this information, but we promise we're going to try to filter through it and give you what's most important.
Absolutely.
And the knowledge crucible, boil it down to the bare essentials.
And speaking of things that have changed, the market, since our last newsletter, a lot has changed. The market has changed in a dramatic way that I think, as Lauren and I were talking about before this, not everyone really realized how much we've changed in the last 3-4 weeks. In fact, our chief investment officer always shares great information with us and sends that out to all our teams. And one of the slides in the deck that he just provided just let us know something that was kind of eye-opening to me, because I don't hear this anywhere. As you were saying, Lauren, too, you don't hear this anywhere. The S&P just had one of its best 10-day periods in its history.
In market history, which is just mind-blowing.
I mean, 9.83% to be specific in a 10-day period, where basically it was up every day. It's incredible. You're not really hearing that in the news. You're hearing, the Straits of Hormuz are open or they're closed again.
Yes, it changed.
Open or closed. But that's what you're hearing a lot of. But I think we want to deliver something that maybe is that you're not hearing, that we do think is important to note, because I don't think a lot of people are aware of that. And then obviously you don't own the index, but it's important to note that that's the general direction of stock prices. And then that's reflected in a lot of your portfolios, depending on the composition of your portfolios to a large extent.
Yeah. So like Nathan said, I'm going to talk a little bit about the risk component, and the risk component is pretty broad based. So we'll just do a couple. Doesn't mean this is all the risks that we see or the ones that are most important to you, but you're still hearing about inflation, and we understand that, when you hear the inflation is 2 or 3%, that doesn't mean all the inflationary increases from the years before haven't added up. So we get it. Inflation,
the cumulative effect.
The cumulative effect, it just stacks. So we're all feeling it. We all drive by the gas station and see the $4 plus gasoline. It's no fun. But if you look at it from a fundamental or an economic statistic kind of component, inflationary pressures are actually relatively low. Mm-hmm. So if you exclude energy, I definitely want to have that as a component. And one of the reasons they exclude energy is that those kinds of fluctuations are more temporal. They're not structural, long lasting. You can make a change, as we've seen. Like Nathan said, when the Strait opens, oil goes below $100. When the Strait's closed, it goes above $100, literally within the day.
And another thing that Bill, our chief investment officer, shared with us as well, just speaking of a historical perspective, right now, if you go back over the last 70 years, you go back to the 50s and you look at these 10-year periods, the CPI, the inflation indicators, we're currently running at about 2.7. Historically, it's been about 3.5.
Right.
And in rates,
that's what I was just about to say. Yeah, it feels high, and like I said, I get it because I purchased a house.
Everyone wants to refi that or they want lending rates to go down, right?
But here's the thing, and I know nobody wants to say this, that's why we're saying it. But if you have a little bit higher rates, but you have a more robust economy, I think I'd take that.
10 times out of 10.
10 times out of 10, because lower rates, if the Fed has to step in to lower rates, that often means that the economy is struggling and they need to increase liquidity. So again, we want to give perspective. You hear a lot about information. It feels like the market's struggling, and I'm sure there's pockets of that's happening, but overall robust. Are there risks? Of course. But right now we're seeing some fundamental strength. The breadth of the market is doing well. Inflation is, again, I hate to say it, but it's doing well historically if we look at it. And job numbers ebb and flow, but we're still below average unemployment. So I think all those things are important. And I'm just going to run right over Nathan as usual, freight train, and kind of tie this into planning, because as we talk about volatile markets, I think there's opportunity there that maybe we've talked about in the past, but not in the same way. So when you have volatile markets, stock prices going up and down every day or every month or every week, whatever it is, there are opportunities to take advantage of that with capital losses. So you can sell at a loss, immediately replace that position and use that to offset the taxes. Or you can do it in a more fundamental institutional way with direct indexing. So since I ran over Nathan a little bit, why don't you talk just for 10 seconds, 15 seconds about direct indexing, and then maybe I can tie in with some more tax planning strategies too.
Yeah, so direct indexing, it's become more and more popular. It's a strategy that we've used for clients, and I think we'll continue to use it for more. It's not the silver bullet and like, hey, every client needs to have direct indexing in their portfolio.
Right. Good
point.
What
we're saying, but I think it's a great strategy for a certain client who might be tax sensitive and then might have a taxable portfolio that we can construct using individual stocks and exposure to individual equities rather than a fund or an ETF, and therefore you're controlling your tax situation much more greatly. And there's extra things that we can do that I won't get into now because I think it's probably not pertinent to enough folks watching this to do so, but there's other ways that we can construct those portfolios to actually generate throughout a positive year, to generate more losses than you would otherwise, and then use those losses against gains in the future. So I think that's a good strategy to use.
And again, you stay invested the whole time. I think that's one of the many secrets that direct indexing has. And we bring this up because we've had a lot of client conversations, whether that's someone that has a high concentration in one stock, or someone that's had a liquidity event and they're in a high tax bracket. They want to put money to work. What's the most tax efficient way to do that? So these are some of the things that we come across.
And because it's tax season. And because we're having a ton of conversations around tax season, right?
We've had a lot of conversations with clients around tax season. And one thing that we communicate, and we're doing it on this newsletter so that everybody knows, is that while we don't prepare taxes, we're not going to do your taxes for you, we can analyze your taxes to see, are there gaps or strategies and solutions that we haven't talked to you about that could either help with future circumstances? And when I say future, it could be 10, 15 years from now. Hey, we're doing Roth conversions now so that you have tax-free money at retirement. Or it could be, hey, you may have some capital gains or losses. Maybe you have a concentrated position. What's that capital gain exposure going to look like? Is it going to push me in another bracket?
Yep.
Like Nathan said, lots of things that we can do when we evaluate those taxes for you. We don't have to get into all of those today, but I thought that was an important planning thought.
Yeah, definitely. And I think I'll end with just our forward thought. I mean, forward thinking ahead, and to kind of wrap up what we've said here today. A lot has changed. You're consuming a ton of information. We're trying to deliver some signals to you apart from kind of all the noise that you hear that we think are important to note. So right out of the gate, we pointed out what the market's done in the last, since the last newsletter. It's been pretty remarkable. Rates are going to probably remain kind of where they are for the near term. That's okay. I think the economy being what it is, being fairly healthy, and the market being fairly strong, we would take that trade-off. As Lauren said, we'd take that trade-off with moderate rates every single time.
It doesn't feel like a win-win, but in reality, it is.
Yeah, and so right now, I think the market has pivoted from focusing on one thing, which it was focusing on for 5 or 6 weeks, to now focusing on earnings season, the earnings of companies, fundamentals. Fundamentals do matter. I mean, you're investing in companies that produce services, that produce goods and services, and if the economy is healthy and people are using those goods and services and earnings are good, I mean, and we're in a increasingly good market, and earnings season has been great. And if you looked at what the conversation was leading into this year, a lot of the conversation was also around the richness of stocks, and stocks are priced very richly.
This is totally
very high.
And I like where you're going.
And so what's happened with the recent kind of almost correction, we were at about 10% on the sell-off, thereabout. And you've seen now the prices of those stocks have come down.
The valuations look much more normal than they did before. And that was a big critique of the market going into the year.
So we would just say, broadly, your long-term outcomes that you're going to experience are much more shaped by fundamentals than they are the market headlines, or the news headlines rather, that you're hypersensitive and focused on, that you think, hey, I'm going to adjust this or adjust that. Most of those times that is really just noise. And then in 3 weeks, 6 weeks, 9 weeks later, a lot of times you're beyond that. And the market is too. The market is forward looking, and it's looking ahead to things that matter in 9 months, a year, and 2 years, et cetera.
Yeah. So, and Nathan and I talked a lot about this, like, what is it that we're trying to do in these videos? We're trying to figure out, if you feel like there's a problem, how can we make your problem our problem and work together to solve it? So if you feel like, hey, you're experiencing tax situation that you need some additional analysis on, hey, the market's too volatile. Am I in the right strategy to match up with my goals? Reach out to us. That's what these videos and newsletters are all about. Trying to get inside your mind, because we can't have everybody on the phone in one call. So please let us know. We'd love to help and talk to you further. So thank you so much, as always, for listening to us, reading the newsletter, and I can't wait to talk to you next month.
We're going to make your problem ours. I like that. Talk to you soon.
All right, bye.